Introduction. Consider Sarah, a bright, ambitious professional who'd always dreamed of financial independence. She devoured books, listened to podcasts, and even attended a few webinars, all focused on the stock market. Armed with what she thought was solid knowledge, she jumped in, buying a few promising stocks. But the moment the market dipped, panic set in. Overwhelmed by fear, she sold at a loss, kicking herself for not being smarter. This pattern repeated itself a few times. Initial enthusiasm followed by paralyzing fear, and ultimately, disappointment. Sarah's story isn't unique. It's the all-too-common tale of letting emotions dictate investment decisions. So many people get stuck in this cycle of overthinking and underperforming. Let's take a moment. Think about a financial decision you made based on fear rather than strategy. What were the circumstances, and what was the outcome? Just sit with that for a few seconds. This audiobook is designed to break that cycle. It's not just another collection of stock tips or technical analyses. It's about building an unshakable financial foundation by mastering your mindset alongside the mechanics of the market. The first thing to understand is that investing is as much a psychological game as it is a financial one. We'll teach you how to identify and manage the emotional triggers that lead to poor decisions. Beyond that, consider the importance of developing a long-term perspective. Short-term market fluctuations are inevitable, but a well-defined strategy, combined with emotional resilience, will help you ride out the waves. What really makes the difference is understanding that mistakes are part of the process. Instead of dwelling on losses, learn from them. Analyze what went wrong, adjust your strategy, and move forward with greater wisdom. This approach will give you the tools you need to confidently navigate the market, not just as a player, but as a master of your own financial destiny. Master your mind, master your money. Building on what we just uncovered. Emotional intelligence. It's a term often associated with personal relationships, but its impact on investment decisions is profound. Think about how easily excitement can turn into irrational exuberance when a stock is soaring, leading you to buy at inflated prices. Conversely, consider how quickly fear can paralyze you during a market downturn, causing you to sell low and miss out on future gains. These emotional responses are deeply ingrained biases that can significantly derail your financial goals. We often see investors chasing the latest hot stock based on hype, only to be left holding the bag when the bubble bursts. Or, consider those who panic sell during market corrections, locking in losses and preventing their portfolios from recovering. Another critical element is understanding the specific biases that affect your decision-making. Are you prone to confirmation bias, seeking out information that confirms your existing beliefs while ignoring contradictory evidence? Or perhaps you suffer from loss aversion, feeling the pain of a loss more acutely than the pleasure of an equivalent gain? The final piece of this puzzle involves developing strategies to mitigate these biases. This might involve setting predefined investment rules, seeking advice from a trusted advisor, or simply taking a break from the market when emotions run high. Here's what separates the amateurs from the pros. Awareness. What are your emotional triggers related to money? What past financial decisions were driven by emotion rather than logic? Understanding these patterns is the first step towards breaking free from them. Recognizing your biases is the cornerstone of sound investing. Know yourself, grow your wealth. Here's where things get interesting. Over the coming chapters, you'll discover a powerful synthesis of proven investment strategies and practical mindset techniques designed to elevate your financial game. This isn't about overnight riches or get-rich-quick schemes. It's about building a solid, sustainable path to financial freedom through knowledge, discipline, and emotional control. You'll learn how to critically evaluate investment opportunities, understand market trends without getting overwhelmed by the noise, and develop a personalized investment strategy that aligns with your specific goals and risk tolerance. We'll be diving deep into the fundamental principles of value investing. We'll also explore various asset allocation strategies, and equally as important, you'll discover actionable techniques for cultivating a resilient mindset, overcoming fear and doubt, and maintaining focus during turbulent times. Think about how many times you've heard conflicting advice from so-called experts. One says buy, another says sell. This audiobook will equip you with the critical thinking skills to discern between sound advice and misleading hype. The final piece of this puzzle involves creating a personalized action plan that you can implement immediately. We'll provide templates, checklists, and exercises to help you translate knowledge into tangible results. Here's what separates the amateurs from the pros: a clear, written plan. Beyond that, consider the importance of continuous learning. The market is constantly evolving, so it's essential to stay informed and adapt your strategy accordingly. What really makes the difference is consistent action. Knowledge without application is just potential, not results. This audiobook provides the roadmap and the tools. Your success depends on your commitment to putting them into practice. Equipping yourself with the knowledge and skills you need will help you navigate the financial landscape with confidence. Learn, apply, thrive. As we move from the why into the how, this audiobook is more than just something to passively listen to. It's designed to be a practical guide, a mentor in your pocket, if you will. To truly benefit from its content, active engagement is key. Think about how much more you retain when you participate in a conversation versus simply listening to a lecture. The same principle applies here. We often see people consume information without taking the time to process and apply it. Here's what separates the amateurs from the pros: the ability to turn knowledge into action. The first thing to understand is the importance of taking notes. Jot down key concepts, strategies, and insights that resonate with you. These notes will serve as a valuable reference guide as you begin implementing what you've learned. Beyond that, consider the power of reflection. After each chapter, take some time to contemplate how the concepts discussed apply to your specific financial situation. What changes do you need to make? What challenges do you anticipate? What really makes the difference is immediate implementation. Don't wait until you've finished the entire audiobook to start putting the strategies into practice. Begin small, experiment, and adjust as you go. Let's take a moment. Imagine yourself 6 months from now, having actively engaged with this material, implemented the strategies, and overcome your financial fears. What does that future look like? What have you accomplished? Hold on to that vision as you continue your journey. By actively engaging with this material through note-taking, reflection, and consistent application, you'll transform information into actionable strategies. Engage deeply, profit greatly. Chapter 1. The Foundation. Stock Market 101. Think about starting a lemonade stand. You need capital to buy lemons, sugar, and a pitcher. You could borrow money, but then you owe it back. Or, you could sell a portion of your future profits to a friend in exchange for their initial investment. That, in essence, is what a company does when it issues stock. It's selling fractional ownership in exchange for capital. So many people look at a stock as simply a ticker symbol on a screen, a number that goes up and down. They forget that behind that symbol lies a real company, with real people, producing real goods or services. The first thing to understand is that when you buy a share of stock, you're becoming a part owner of that company. Beyond that, consider the implications of that ownership. As a shareholder, you're entitled to a portion of the company's profits, typically distributed as dividends. You also have a say in how the company is run, with voting rights on important decisions. What really makes the difference is understanding the long-term value creation that comes with ownership in a successful business. Instead of focusing solely on short-term price fluctuations, consider the company's long-term prospects, its competitive advantage, and its ability to generate profits over time. Let's take a moment. Imagine you are approached to invest in a local business you admire. What qualities would you look for before investing your money? That essential understanding transforms investing from gambling into calculated ownership. Own your future, one share at a time. Building on what we just uncovered, the terms bull market and bear market are thrown around constantly, but what do they really mean? And more importantly, how should they influence your investment decisions? Think about it like this. A bull charges upward, representing a market that's generally rising. Conversely, a bear swipes downward, symbolizing a market that's declining. We often see novice investors getting caught up in the euphoria of a bull market, buying stocks indiscriminately, only to be crushed when the bear inevitably arrives. Or, they panic sell during a bear market, locking in losses and missing out on the subsequent recovery. Another critical element is understanding that these market sentiments are cyclical. Bull markets don't last forever, and neither do bear markets. The final piece of this puzzle involves developing a strategy that allows you to profit from both. Here's what separates the amateurs from the pros: the ability to remain disciplined and objective, regardless of the prevailing market sentiments. The first thing to understand is that a bull market is a great time to take profits and rebalance your portfolio. This allows you to sell high and have cash on hand to buy low when the bear arrives. Beyond that, consider that a bear market presents opportunities to buy quality stocks at discounted prices. This requires courage and conviction, but it can significantly boost your long-term returns. Understanding market cycles is crucial, but emotional control is paramount. Know the trend, control the bend. Let's take this a step further. Navigating the stock market can feel like learning a new language. Words like dividends, IPOs, and market capitalization can sound intimidating. But understanding these terms is essential for making informed investment decisions. Think about how confusing it would be to travel to a foreign country without knowing the local language. The same principle applies to the stock market. We often see investors making poor choices simply because they don't understand the terminology being used. Here's what separates the amateurs from the pros: a firm grasp of the fundamental vocabulary. The first thing to understand is what dividends are. They're essentially a share of a company's profits paid out to its shareholders, like getting regular royalty checks for owning a piece of the business. Beyond that, consider IPOs, or initial public offerings. This is when a private company offers shares to the public for the first time. While IPOs can be exciting, they also come with increased risk due to limited historical data. What really makes the difference is understanding market capitalization, which is simply the total value of a company's outstanding shares. It's calculated by multiplying the share price by the number of shares outstanding. Market cap helps you understand the size and relative stability of a company. Before we move on, consider the value each of these three terms brings to your overall investment understanding. Knowing the language unlocks the investment landscape. Speak the language, build your fortune. While that covers the essentials, seasoned professionals know there's more. The stock market isn't just some abstract concept. It's a collection of marketplaces, like the New York Stock Exchange, NYSE, and the NASDAQ, where buyers and sellers come together to trade shares of publicly held companies. Think about these exchanges as giant auction houses, where the price of a stock is determined by supply and demand. We often see new investors overlooking the critical role these exchanges play in providing liquidity. Without these established marketplaces, it would be much more difficult to buy or sell stocks quickly and efficiently. The final piece of this puzzle involves understanding that these exchanges are heavily regulated to protect investors from fraud and manipulation. Another critical element is understanding how market makers play a role in providing liquidity. These firms stand ready to buy or sell shares at any time, helping to ensure that there's always a market for your stocks. The first thing to understand is that the existence of these exchanges is what allows you to easily convert your stocks back into cash when you need to. Beyond that, consider how the competition between different exchanges helps to drive down trading costs and improve efficiency for investors. The exchanges provide a structured framework for trading, promoting fairness and transparency. Trade with knowledge, invest with confidence. Now, understanding the theory is one thing, but applying it is quite another. Many people feel overwhelmed by the prospect of investing, and that feeling often leads to procrastination. A simple way to overcome that initial fear is to start with research, without the pressure of actually buying anything. Think about a product or service you admire. Perhaps it's a brand you use regularly, or a company whose mission resonates with you. We often see that the first step is the hardest, so just focusing on information gathering is a victory in itself. The first thing to understand is that you can learn a great deal about a company simply by visiting its website and reading its annual reports. Beyond that, consider using financial websites to look up the company's stock ticker symbol and explore its key financial metrics, such as revenue, earnings, and debt. What really makes the difference is to start small and to make it enjoyable. This initial research will not only demystify the stock market, but also build your confidence and lay the foundation for making informed investment decisions down the road. Let's take a moment. Close your eyes and visualize yourself confidently researching a company, understanding its financials, and making informed decisions. Feel that sense of accomplishment and empowerment. Taking this first step into research unlocks the potential for overcoming fear. Research first, invest later, profit always. Chapter 2. Overthinking, the investor's silent enemy. Consider a chess player who spends so much time analyzing every possible move that they never actually make one. Their opponent, acting more decisively, wins the game. This is a perfect analogy for analysis paralysis in investing. It's the state of overthinking and overanalyzing, to the point where you become incapable of taking action. So many people get caught in this trap, endlessly researching and planning, but never actually pulling the trigger on an investment. Another critical element is recognizing that the pursuit of perfection is a major driver of overthinking. The final piece of this puzzle involves accepting that investing involves inherent uncertainty, and it's impossible to predict the future with 100% accuracy. Here's what separates the amateurs from the pros. They understand that good enough is often better than perfect, especially when it comes to investing. The first thing to understand is that the market is constantly changing, and opportunities can disappear quickly. By the time you've gathered every possible piece of information, the ideal moment to invest may have already passed. Beyond that, consider that small, incremental investments are often more effective than waiting for the perfect opportunity to invest a large sum of money. Overthinking prevents action, and action is essential for achieving financial goals.
Action beats analysis, always.
Building on what we just uncovered. At the heart of overthinking lies the fear of making mistakes. Nobody wants to lose money. But the truth is that mistakes are an inevitable part of the investment journey. Think about learning to ride a bike. You're going to fall a few times before you find your balance. It's the same with investing. We often see people beating themselves up over investment mistakes, allowing those experiences to paralyze them from taking future action. The first thing to understand is that every mistake provides a valuable learning opportunity. Beyond that, consider reframing your perspective on losses. Instead of viewing them as failures, see them as tuition payments for your investment education. The final piece of this puzzle involves developing a system for analyzing your mistakes and identifying areas for improvement. Here's what separates the amateurs from the pros. They don't dwell on past losses. They extract lessons and move forward with greater wisdoms. Before we move on, think of one mistake you've made in the past. Now consider one positive thing you learned from that experience. Embracing mistakes transforms them into stepping stones to success. Learn from losses. Build your gains. Let's take this a step further. Overthinking is often fueled by negative thought patterns that create self-doubt and anxiety. Learning to identify and counteract these patterns is crucial for taking control of your investment decisions. Think about the common thought, "I'm not smart enough to understand the market," or "I'm going to lose all my money." We often see these negative self-statements holding people back from even getting started. Here's what separates the amateurs from the pros: the ability to manage their inner dialogue. The first thing to understand is that you can challenge these negative thoughts by asking yourself, is this thought really true? Is there evidence to support it? Beyond that, consider the power of positive affirmations. These are positive statements that you repeat to yourself regularly to build confidence and self-belief. For example, instead of thinking, "I'm going to lose all my money," you might affirm, "I am a capable investor, and I make smart, informed decisions." What really makes the difference is consistency. The more you practice these affirmations, the more they will become ingrained in your subconscious mind. Positive thought patterns are tools to combat negative thinking. Affirm success, achieve wealth. While that covers the essentials, seasoned professionals know there's more. The relentless pursuit of perfection is a significant driver of overthinking, leading to inaction and missed opportunities. The idea that every investment must be a guaranteed home run is unrealistic and ultimately paralyzing. Think about a baseball player. Even the best hitters only get a hit about 3 out of 10 times. In investing, it's about increasing your odds of success, not eliminating risk entirely. We often see people missing excellent investment opportunities because they're holding out for the perfect one, which rarely exists. The first thing to understand is that calculated risks are an essential part of wealth building. Beyond that, consider that time in the market is generally more important than timing the market. What really makes the difference is to embrace the concept of good enough. It's about making informed decisions based on available information and taking action, rather than endlessly seeking elusive perfection. Let's take a moment to visualize yourself making a well-informed investment decision, even if it's not perfect. Feel the sense of confidence and empowerment that comes from taking action. Accepting calculated risks over inaction fuels financial progress. Good enough now is better than perfect never. As we move from the why into the how, overcoming overthinking isn't about making massive, sweeping changes overnight. It's about taking small, consistent actions that build momentum, create possibilities, and ultimately lead to unwavering confidence. Think about how learning a new language starts with mastering a few basic phrases. Each phrase you learn builds upon the previous one, gradually expanding your fluency. It's the same with investing. We often see that starting small is the key to overcoming inertia and building confidence. The final piece of this puzzle involves celebrating your small victories along the way. Another critical element is visualizing your future success. The first thing to understand is that even researching a single stock
can be a significant step forward. It demonstrates that you're taking control of your financial future. Beyond that, consider opening a small brokerage account and making a tiny initial investment. This tangible action will solidify your commitment and provide valuable learning experience. What really makes the difference is to realize that each small step contributes to building a solid foundation of knowledge, experience, and confidence. By taking small, consistent actions, you'll overcome overthinking and build the confidence to make smarter investment decisions. Small steps now, giant leaps later.
Chapter 3. Mindfulness, your investment superpower. Consider a time when you were driving and suddenly realized you didn't remember the last few miles. Your body was present, but your mind was elsewhere.
This is the opposite of mindfulness. Mindfulness is the practice of being fully present in the moment, without judgment. It's about paying attention to your thoughts, feelings, and sensations, without getting carried away by them. So many people make investment decisions while distracted, stressed, or emotionally charged, leading to impulsive and often regrettable choices. The first thing to understand is that mindfulness can significantly reduce anxiety related to investing. Beyond that, consider how mindfulness can improve your decision-making by allowing you to approach situations with greater clarity and objectivity. What really makes the difference is recognizing that mindfulness is a skill that can be cultivated through practice, like any other skill. Let's take a moment. Close your eyes. Take a deep breath and focus on the sensation of the air entering and leaving your body. Let go of any thoughts or worries that come to mind and simply be present in this moment. Practicing mindfulness allows you to approach investing with greater calm and clarity. Be present, invest wisely. Building on what we just uncovered, the true power of mindfulness lies in its application to real-world situations, including your investment decisions. It's not just about sitting in meditation. It's about cultivating a heightened awareness of your thoughts and emotions as they arise in the context of the market. Think about how quickly fear can grip you when you see your portfolio value declining. Mindfulness allows you to observe that fear without being consumed by it. We often see people reacting impulsively to market fluctuations, selling low out of panic or buying high out of greed. Another critical element is creating space between your thoughts and your actions. The first thing to understand is that when you feel a strong emotional urge to buy or sell, pause. Take a few deep breaths and simply observe the feeling without judging it. Beyond that, consider asking yourself, is this decision aligned with my long-term investment strategy, or am I simply reacting to short-term market noise? The final piece of this puzzle involves practicing non-judgmental awareness. Acknowledge your emotions, but don't let them dictate your actions. Practicing mindfulness can prevent impulsive decisions, leading to more rational investment strategies. Observe, don't react, grow your stack. Let's take this a step further. Meditation isn't some mystical practice reserved for monks. It's a practical tool for calming your mind and reducing stress, creating the mental space you need for rational decision-making. Think about your mind as a turbulent ocean. Meditation is like stilling the waters, allowing the sediments to settle and revealing the clarity beneath. We often see people reacting impulsively because their minds are cluttered with worries and distractions. The first thing to understand is that you don't need to dedicate hours to meditation to experience its benefits. Even just 5 or 10 minutes a day can make a significant difference. Beyond that, consider a simple breathing meditation technique. Find a quiet place, close your eyes, and focus on your breath. Inhale deeply, exhale slowly, and simply observe the sensation of your breath entering and leaving your body. When your mind wanders, gently guide your attention back to your breath. What really makes the difference is consistency. Make meditation a regular part of your routine, just like brushing your teeth. Consistent meditation practices cultivate calmness and improve focus, which are crucial for smart investing. Meditate daily, invest sanely. While that covers the essentials, seasoned professionals know there's more. Market volatility can trigger intense anxiety, leading to impulsive decisions that can derail your financial goals. Mastering simple breathing exercises can be a powerful tool for managing that anxiety and regaining composure. Think about the last time you felt truly panicked. Your breathing probably became shallow and rapid. By consciously controlling your breath, you can directly influence your nervous system and calm yourself down. We often see investors making rash decisions during market downturns, driven by fear rather than logic. The first thing to understand is the 4-7-8 breathing technique. Inhale deeply through your nose for a count of 4. Hold your breath for a count of 7, and exhale slowly through your mouth for a count of 8. Repeat this cycle several times. Beyond that, consider practicing this technique regularly, even when you're not feeling anxious. This will help you build a conditioned response that you can easily access when you need it most. What really makes the difference is to use this technique as a circuit breaker when you feel overwhelmed by market volatility. Step away from your computer, practice the breathing exercise, and then return to your investment decisions with a clearer head. Controlling your breath controls your anxiety, leading to calmer and more rational decisions. Breathe in calm, breathe out fear. As we move from the why into the how, mindfulness isn't about ignoring market trends. It's about observing them without emotional attachment. It's about separating objective analysis from subjective feelings to make rational investment choices. Think about a scientist conducting an experiment. They observe the results objectively, without letting their personal biases influence their interpretation of the data. It's the same with investing. We often see that investors become emotionally attached to their investments, leading them to hold on to losing stocks for too long or to chase after speculative bubbles. The first thing to understand is that you can practice observing market trends as an outside observer, recognizing that you are not your portfolio. Beyond that, consider setting clear rules for when you will buy or sell a stock, based on objective criteria, and stick to those rules, regardless of your emotions. What really makes the difference is journaling your investment decisions and reflecting on the role your emotions played in those choices. This will help you identify patterns of emotional reactivity and develop strategies for managing them more effectively in the future. Before we move on, consider the positive benefits that can come from detaching your emotions from market volatility. Detached observation enables rational investing, securing long-term financial success. See the trend, not the fear. Build wealth year after year. Chapter 4. Solution-oriented thinking, turning problems into profits. Consider the story of Airbnb. Two designers couldn't afford their San Francisco rent. Instead of dwelling on the problem, they saw an opportunity. They had space, and a design conference was coming to town, so hotels would likely be full. They offered their spare room and breakfast, creating what is now a multi-billion-dollar company. That is solution-oriented thinking in action. It's about reframing problems to view the opportunities and possibilities they present, rather than getting bogged down in negativity. The first thing to understand is that every problem contains the seed of an opportunity. Beyond that, consider that focusing on solutions rather than problems is more energizing and empowering. What really makes the difference is training yourself to ask questions like, "What's possible here?" Or, "How can I turn this challenge into an advantage?" Another critical element is the ability to innovate. Problems often force us to think outside the box and develop creative solutions that lead to new products, services, and business models. Solution-oriented thinking unlocks new possibilities, transforming challenges into profitable ventures. See the solution. Seize the fortune. Building on what we just uncovered, the questions you ask yourself often dictate the focus and course of your thought process. If you ask questions that focus on blame, negativity, and limitations, you'll inevitably get answers that reinforce those perspectives. But if you ask questions that stimulate solutioning, you'll unlock new possibilities and generate creative ideas. Think about how a detective investigates a crime. They don't just ask, "Who is to blame?" but, "What happened? How did it happen? What clues can we find?" We often see people getting stuck in problem-focused thinking because they're asking the wrong questions. The first thing to understand is that you can reframe any problem by asking different questions. Beyond that, consider replacing negative self-talk with solution-oriented inquiries. What really makes the difference is actively challenging your default thought patterns and consciously choosing questions that empower you to find solutions. The final piece of this puzzle involves learning to identify common problem-focused questions and consciously replacing them with their solution-oriented counterparts. Let's take a moment to visualize yourself transforming a negative question into a positive, solution-oriented one. Feel the surge of creativity and empowerment. Asking the right questions unlocks innovative solutions. Ask solutions. Find fortunes. Let's take this a step further. Making a conscious effort to turn your focus and thought towards solutions requires intentionality and consistent practice. It's about actively redirecting your mental energy away from dwelling on problems and toward identifying potential solutions. Think about how learning a new habit requires conscious effort at first. You have to actively remind yourself to perform the desired action until it becomes automatic. It's the same with solution-oriented thinking. We often see people getting stuck in negative thought patterns because they haven't consciously trained themselves to focus on solutions. The first thing to understand is that you can start small by consciously choosing to focus on one solution, no matter how small, for every problem you encounter. Beyond that, consider creating a solution journal where you write down problems and potential solutions, tracking your progress over time. What really makes the difference is to actively cultivate a mindset of optimism and possibility, believing that solutions are always within reach. Another critical element is surrounding yourself with people who are also solution-oriented thinkers. Their positive energy will reinforce your own commitment to finding solutions and creating opportunities. Focusing your thoughts and actions towards solutions paves the way to positivity and financial progression. Focus on solutions. Build new fortunes. While that covers the essentials, seasoned professionals know there's more. A critical element of solution-oriented thinking is focusing your energy on what you can control. Controllable items are actionable items. Don't let uncontrollable items distract or diminish your resolve. Think about navigating a storm at sea. You can't control the wind or the waves, but you can control the sails and the rudder. It's the same with investing. You can't control market fluctuations or economic recessions, but you can control your investment strategy, your risk tolerance, and your savings rate. We often see investors getting overwhelmed and discouraged by uncontrollable events, leading them to abandon their long-term plans. The first thing to understand is that you can identify the elements of any problem that are within your control. Beyond that, consider focusing all your energy on those controllable aspects, taking concrete steps to improve your situation. What really makes the difference is to consciously detach from the uncontrollable factors, accepting them as part of the reality, and refusing to let them derail your efforts. Think of a situation where you felt overwhelmed by uncontrollable factors. Now, visualize yourself identifying the aspects you can control and taking decisive action. Focusing on actionable items empowers you to overcome obstacles and achieve your goals. Control what you can. Conquer your plan. As we move from the why into the how, reward systems are a fantastic way to positively reinforce solution-oriented thinking. Reinforcement allows for better habit building and a better attitude. Think about how trainers use treats to reinforce positive behaviors in animals. It's a simple but powerful principle of learning. We often see people struggling to adopt new habits because they don't have a system for rewarding themselves along the way. The first thing to understand is that you can create your own reward system to encourage solution-oriented thinking. Beyond that, consider defining specific rewards for achieving certain milestones in your problem-solving journey. What really makes the difference is to align your rewards with your values and interests, making them truly motivating and enjoyable. The final piece of this puzzle involves celebrating your successes, no matter how small. Acknowledging your progress will reinforce your commitment to solution-oriented thinking and build your confidence in your ability to overcome challenges. Rewarding solution-oriented actions cultivates a positive attitude and makes the journey toward progress much more enjoyable. Reward the solve. Watch wealth evolve. Chapter 5. Risk Management. Protecting your portfolio and peace of mind. Imagine building a beautiful house on a shaky foundation. No matter how elegant the design, the structure is vulnerable to collapse. Similarly, an investment portfolio built without proper risk management is vulnerable to significant losses. Managing risk isn't about avoiding it altogether, but about understanding it, assessing it, and mitigating it to protect your hard-earned wealth. The final piece of this puzzle involves understanding that knowing your risk tolerance is the foundation of sound asset allocation. The first thing to understand is that assessing your personal risk tolerance is the crucial first step. Beyond that, consider taking a self-assessment quiz to determine your risk tolerance. The link is in the resources section. What really makes a difference is to carefully consider your answers and to be honest with yourself about your true feelings about risk. Think about what it feels like to lose money. How does your body react? That gut feeling will give you some insight. Assessing your risk tolerance sets the stage for constructing a resilient and balanced portfolio. Know your risk, manage your stack. With that foundation firmly in place, one of the cornerstones of effective risk management is diversification. It's a simple concept with profound implications for protecting your portfolio and your peace of mind. Think about the old saying, don't put all your eggs in one basket. If that basket falls, you lose everything. Similarly, if you invest all your money in a single stock or asset class, you're exposed to significant risk. We often see that investors who lack diversification experience far greater volatility in their portfolios, leading to anxiety and potentially disastrous decisions. The first thing to understand is that diversification means spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. Beyond that, consider that each asset class has its own unique risk and return characteristics. What really makes the difference is to create a diversified portfolio that aligns with your risk tolerance and your investment goals. Another critical element is understanding that diversification is not a guarantee against losses, but it significantly reduces portfolio volatility and minimizes the impact of any single investment performing poorly. Diversification mitigates risk and promotes long-term investment stability. Diversify wisely, grow exponentially. Let's take this a step further. Another valuable tool for limiting potential losses and protecting your capital is the stop-loss order. It's like having an automatic safety net for your investments. Think about it like car insurance. You hope you never need it, but it's there to protect you from catastrophic financial loss in case of an accident. It is the same with investments. We often see people holding on to losing stocks for too long, hoping they will eventually recover, only to see their losses deepen. The first thing to understand is that a stop-loss order is an instruction to your broker to automatically sell a stock when it reaches a certain price. Beyond that, consider setting stop-loss orders at a level that is consistent with your risk tolerance and your investment strategy. What really makes a difference is to regularly review and adjust your stop-loss orders as market conditions change. The final piece of this puzzle involves recognizing that stop-loss orders are not a foolproof solution and can sometimes be triggered by short-term market fluctuations, but they can be an effective tool for protecting your capital and your emotional well-being. Using stop-loss orders safeguards your investments and contributes to a sense of financial security. Set stop-loss. Avoid the loss. While that covers the essentials, seasoned professionals know there's more. Effectively managing risk also involves understanding the concept of position sizing. This refers to the amount of capital you allocate to any single investment. The goal is to limit your exposure to any single investment to avoid devastating losses if that investment performs poorly. Think about a general leading an army. They wouldn't commit all their troops to one battle, because if they lost that battle, they'd lose the entire war. It's the same with investing. We often see that investors who allocate a disproportionate amount of their capital to a single investment are taking on excessive risk. The first thing to understand is that you can determine an appropriate position size based on your risk tolerance and the potential volatility of the investment. Beyond that, consider limiting your exposure to any single investment to a certain percentage of your overall portfolio. For example, 1% to 5%. What really makes the difference is to consistently apply this principle across all your investments, ensuring that no single loss can significantly impact your overall financial well-being. Applying position sizing principles ensures no single bad investment decision can significantly damage your portfolio. Size your position, minimize the risk's attrition. As we move from the why into the how, before you even consider investing, it's crucial to secure your financial base by establishing an emergency fund. This is a non-negotiable aspect of responsible risk management. Think about building a house. You wouldn't start constructing the walls before laying a solid foundation. Similarly, you shouldn't expose your hard-earned money to market risk before you have a financial safety net in place. We often see people getting into financial trouble because they invest before they have an adequate emergency fund, forcing them to sell investments at a loss when unexpected expenses arise. The first thing to understand is that an emergency fund is a readily accessible pool of cash to cover unexpected expenses, such as medical bills, job loss, or car repairs. Beyond that, consider aiming to have at least 3 to 6 months' worth of living expenses in your emergency fund. What really makes the difference is to keep your emergency fund in a safe, liquid account, such as a high-yield savings account or a money market account, where it's easily accessible when you need it. Securing an emergency fund before investing provides financial security and prevents you from taking unnecessary risks. Fund your safety net, then invest without regret. Chapter 6. Long-term versus short-term. Choosing your investment horizon. Consider the tale of two investors. Investor A starts investing $5,000 a year at age 25 and stops at age 35. Investor B starts at age 35 and invests $5,000 a year until age 65. Assuming an average annual return of 8%, Investor A, who who invested for only 10 years, ends up with significantly more money at age 65 than investor B, who invested for 30 years. This illustrates the power of compounding and the advantage of starting early. Understanding the distinction between long-term and short-term investment strategies is critical for achieving your financial goals. The first thing to understand is the power of compounding. Compounding is earning returns not only on your initial investment, but also on the accumulated interest or gains. Beyond that, consider that the longer your money has to compound, the greater the potential for exponential growth. What really makes the difference is to start investing as early as possible, even if it's just a small amount, to harness the power of compounding growth over time. Harness time and start your exponential growth journey. Start early, grow richly. With that foundation firmly in place. While long-term investing is often the preferred strategy for most individuals, it's important to acknowledge the existence of short-term trading strategies. However, it's crucial to understand the risks and rewards associated with these approaches. Think about playing professional poker. While there's the potential for quick wins, it requires a deep understanding of the game, significant skill, and a willingness to accept substantial losses. It is the same with short-term trading. We often see people drawn to the allure of quick profits, only to discover that it's far more challenging and risky than they initially imagined. The first thing to understand is that short-term trading involves buying and selling assets within a short period, often days or even hours, with the goal of profiting from small price fluctuations. Beyond that, consider that short-term trading requires significant time, expertise, and discipline. What really makes the difference is to carefully assess your skills, resources, and risk tolerance before engaging in short-term trading strategies. Another critical element is recognizing that short-term trading is more akin to speculation than investing, and that the vast majority of short-term traders lose money. Short-term trading involves higher risks and requires specialized skills and dedicated time. Trade smart, or build wealth apart. Let's take this a step further. For the vast majority of individuals, long-term investing is the most effective strategy for building wealth over time. It's a patient and disciplined approach that allows you to harness the power of compounding and ride out market fluctuations. Think about planting a tree. You don't expect it to grow into a towering giant overnight. It takes time, patience, and consistent care. It is the same with long-term investing. We often see that investors who focus on long-term goals and stick to their plans through thick and thin are far more successful than those who try to time the market or chase after short-term gains. The first thing to understand is that long-term investing involves buying and holding assets for an extended period, often years or even decades. Beyond that, consider focusing on fundamentally strong companies with long-term growth potential. What really makes the difference is to diversify your portfolio across different asset classes and to rebalance it periodically to maintain your desired asset allocation. Imagine yourself, years from now, reaping the rewards of your patient, long-term investments, enjoying financial security and peace of mind. A long-term investing approach allows you to accumulate wealth steadily and achieve your financial dreams. Invest long, retire strong. While that covers the essentials, seasoned professionals know there's more. A crucial step in choosing your investment horizon is aligning your investment strategies with your financial goals. In other words, what are you investing for, and when will you need the money? Think about planning a road trip. You wouldn't choose a route without knowing your destination and how much time you have to get there. Similarly, you shouldn't select investment strategies without considering your financial goals and your time horizon. We often see people making investment mistakes because they haven't clearly defined their goals, or they choose investment strategies that are inconsistent with their time horizon. The first thing to understand is that you can define your financial goals and determine whether they are short-term or long-term. Beyond that, consider that short-term goals, such as saving for a down payment on a house or paying for a vacation, typically require a more conservative investment approach. What really makes the difference is to regularly review and adjust your investment strategies as your financial goals and your time horizon change. Aligning your investment horizon with your financial goals is key to achieving financial success. Goal defined, horizon aligned. As we move from the why into the how, investing is truly a game of patience, so resist the temptation to fall into the trap of short-term thinking. Remember, get-rich-quick schemes rarely work and often lead to significant losses. Think about a marathon runner. They don't sprint the entire race. They pace themselves, conserve energy, and stay focused on the finish line. It is the same with investing. We often see that investors who get caught up in short-term market trends or emotional impulses make poor decisions that undermine their long-term financial goals. The first thing to understand is that market fluctuations are a normal part of the investment process, and that trying to time the market is a fool's errand. Beyond that, consider developing a long-term investment plan and sticking to it, regardless of short-term market volatility. What really makes the difference is to regularly review your portfolio, rebalance it as needed, and stay focused on your long-term financial goals. Let's take a moment to visualize your long-term investment goals, feeling the satisfaction and security that comes with achieving them. Staying focused on your investment goals is the key to building wealth over time. Be patient. Build lasting affluence. Chapter 7. Fundamental Analysis. Understanding what you're buying. Imagine you're considering buying a used car. You wouldn't just kick the tires and take it for a quick spin, would you? You'd want to thoroughly inspect the engine, check the mileage, and review the maintenance records. Similarly, before investing in a company, it's crucial to thoroughly examine its financial health and understand its underlying value. This is where fundamental analysis comes in. The first thing to understand is that fundamental analysis involves evaluating a company's financial statements to assess its intrinsic value. Beyond that, consider that the three key financial statements are the balance sheet, the income statement, and the cash flow statement. What really makes the difference is to learn how to read and interpret these reports to gain insights into a company's assets, liabilities, revenues, expenses, and profitability. The final piece of this puzzle involves understanding that these reports allow you to evaluate a company's financial health. Analyzing financial statements unlocks the power to evaluate a company's true worth. Analyze deep, invest deep. With that foundation firmly in place, while understanding financial statements is essential, it's also important to know how to use key financial ratios to analyze a company's performance. Think about comparing the nutritional information on two different food labels. You wouldn't just look at the total calories. You'd also want to compare the amounts of fat, protein, and carbohydrates. It is the same with analyzing financial statements. We often see people getting overwhelmed by the sheer amount of data. But financial ratios can help you to distill the information into meaningful insights. The first thing to understand is that financial ratios are calculated using data from a company's financial statements and provide insights into its profitability, liquidity, solvency, and efficiency. Beyond that, consider familiarizing yourself with key ratios such as the price-to-earnings ratio, PE ratio, the debt-to-equity ratio, and the return on equity, ROE. What really makes the difference is to compare these ratios to industry averages or to the company's own historical performance to identify undervalued or overvalued stocks. Analyzing financial ratios provides valuable insights for identifying investment opportunities. Ratio reads, profit seed. Let's take this a step further. In addition to analyzing a company's financial statements, it's crucial to analyze the industry in which it operates. A company's success is often heavily influenced by the broader industry trends and dynamics. Think about sailing a boat. It's easier and faster to sail with the wind than against it. Similarly, a company operating in a growing industry has a significant advantage over one operating in a declining industry. We often see people investing in companies without considering the industry outlook, only to be disappointed when the company struggles despite having seemingly strong financials. The first thing to understand is that you can analyze an industry by examining its growth rate, competitive landscape, and regulatory environment. Beyond that, consider focusing on industries with strong growth potential, such as technology, healthcare, or renewable energy. What really makes the difference is to identify companies that are well-positioned to capitalize on these industry tailwinds and gain market share. Evaluating the industry helps you identify promising investment opportunities within favorable market environments. Industry insight. Profits take flight. While that covers the essentials, seasoned professionals know there's more. Another crucial aspect of fundamental analysis involves identifying the factors that give a company a competitive advantage. In essence, what makes this company special and allows it to outperform its competitors. Think about a chess match. A skilled player doesn't just randomly move pieces. They strategically position them to gain a competitive advantage. Similarly, a successful company possesses unique strengths that enable it to thrive in the marketplace. We often see people investing in companies without understanding their competitive advantages, only to be disappointed when they lose market share and profitability. The first thing to understand is that competitive advantages can take many forms, such as a strong brand, proprietary technology, a unique distribution network, or a cost advantage. Beyond that, consider that a sustainable competitive advantage is one that is difficult for competitors to replicate. What really makes the difference is to identify companies with durable competitive advantages that will enable them to generate consistent profits over the long term. Identifying a company's unique competitive advantages can reveal strong long-term investment opportunities. Advantage clear, future is here. As we move from the why into the how, a critical and often overlooked aspect of fundamental analysis is assessing the quality of a company's management team. Even the best companies can falter under poor leadership, while a competent management team can often turn around struggling businesses. Think about the captain of a ship. A skilled captain can navigate through stormy seas and guide the ship safely to its destination, while an incompetent captain can run it aground. It is the same with a company's management team. We often see investors focusing solely on the numbers, neglecting the crucial role that management plays in executing strategy and creating shareholder value. The first thing to understand is that a competent management team is essential for executing strategy, allocating capital effectively, and building a strong corporate culture. Beyond that, consider evaluating the management team's track record, experience, and integrity. What really makes the difference is to look for leaders who are transparent, accountable, and have a proven ability to create long-term shareholder value. A skilled management team can transform a good company into a great investment. Lead well, profit swell. Chapter 8. Technical Analysis. Reading the market's signals. Imagine trying to predict the weather without looking at a weather map. You might be able to guess based on your general knowledge of the climate, but you'd be much more accurate if you had access to visual data showing temperature patterns, wind direction, and precipitation forecasts. Similarly, technical analysis uses charts and other tools to visualize price movements and identify trends in the market. The first thing to understand is that technical analysis is a method of evaluating investments by analyzing past market data, primarily price and volume. Beyond that, consider that charts are an essential tool in technical analysis, providing a visual representation of price movements over time. What really makes the difference is to familiarize yourself with different types of charts, such as line charts, bar charts, and candlestick charts, and to understand how to interpret the information they convey. Understanding different chart types provides a valuable foundation for visualizing market trends. Chart the course, force the source. With that foundation firmly in place, one of the most fundamental concepts in technical analysis is understanding support and resistance levels. These are key areas on a chart where the price tends to bounce or stall, offering potential insights into future price movements. Think about a ball bouncing on the floor. The floor acts as a support level, preventing the ball from falling further. The ceiling acts as a resistance level, preventing the ball from rising higher. It's the same with support and resistance levels in the market. We often see that prices struggle to break through these levels, creating opportunities for traders. The first thing to understand is that a support level is a price level where buying pressure is strong enough to prevent the price from falling further. Beyond that, consider that a resistance level is a price level where selling pressure is strong enough to prevent the price from rising further. What really makes the difference is to use support and resistance levels to identify potential entry and exit points for your trades. Identifying support and resistance levels helps anticipate price movements and make informed trading decisions. Levels known, gains are sown. Let's take this a step further. Another valuable tool in technical analysis is the use of moving averages. Moving averages help to smooth out price fluctuations and provide a clearer picture of the underlying trend. Think about taking an average of your daily test scores. A single high or low score might not accurately reflect your overall performance, but a moving average would smooth out the fluctuations and give you a better sense of your progress over time. It is the same with moving averages in the market. We often see that prices can be volatile in the short term, but moving averages help to filter out the noise and identify the prevailing trend. The first thing to understand is that a moving average is calculated by averaging the price of an asset over a specific period. Beyond that, consider that common moving average periods include 50-day, 100-day, and 200-day moving averages. What really makes the difference is to use moving averages to confirm the direction of a trend and to identify potential buying or selling opportunities. By smoothing out price data, moving averages illuminate the underlying trend and guide investment decisions. Trend revealed, profit sealed. While that covers the essentials, seasoned professionals know there's more. While analyzing price patterns is crucial, Understanding trading volume is also vital in technical analysis. Volume confirms the strength and validity of price movements, offering valuable insights into market sentiment. Think about a crowded concert. The energy and enthusiasm of the crowd amplify the performance on stage. Similarly, high trading volume confirms the strength and conviction behind a price move in the market. We often see that prices can move on low volume, but these moves are often short-lived and unreliable. The first thing to understand is that trading volume represents the number of shares or contracts traded during a specific period. Beyond that, consider that high volume typically indicates strong conviction behind a price move, while low volume suggests a lack of interest. What really makes the difference is to use volume to confirm the validity of price patterns and to identify potential breakout or breakdown scenarios. Volume confirms price action, strengthening conviction and informing trading decisions. Volume speaks, fortune seeks. As we move from the why into the how, to be successful in the markets, you have to be able to identify and exploit trends. Understanding how to use and identify trend lines is a vital skill. Think about surfing. A surfer looks for the wave and rides with it, using its power. Similarly, identifying the trend and trading with it will give you the greatest chances of success. We often see traders fighting the trend, trying to pick tops or bottoms, and they get hurt. The first thing to understand is that an uptrend is characterized by higher highs and higher lows, while a downtrend is characterized by lower highs and lower lows. Beyond that, consider drawing trend lines connecting the lows in an uptrend or the highs in a downtrend. What really makes a difference is trading in the direction of the trend and using trendline breaks as potential entry or exit signals. Another critical element is to always use stop-loss orders to limit your risk. Look at a chart and identify the potential trades. Ride the trend, profits tend. Chapter 9. Investing Psychology, Managing Your Emotions. Consider a high-stakes poker game. Players with the best cards don't always win. Often, it's the player who best manages their emotions, controlling their fear when facing a big bet, or restraining their greed when on a winning streak, who walks away with the pot. Similarly, in investing, emotional discipline is often more critical than raw intelligence. Fear and greed are powerful emotions that can lead to irrational decisions, causing investors to buy high and sell low, sabotaging their long-term financial goals. The first thing to understand is that fear and greed are inherent human emotions that can significantly impact investment decisions. Beyond that, consider that fear often leads to panic selling during market downturns, while greed drives investors to chase after hot stocks or speculative assets, often at the peak of a bubble. What really makes the difference is to develop strategies to counteract these emotional biases, such as creating a well-diversified portfolio, sticking to a long-term investment plan, and avoiding emotional decision-making. Controlling your emotions is as important as understanding the financial markets. Mindful investing, steady profiting. With that foundation firmly in place. Another common pitfall in investing is confirmation bias. It's a psychological tendency to seek out information that confirms our existing beliefs, while ignoring or downplaying information that contradicts them. Think about reading news articles about your favorite political candidate. You're more likely to pay attention to articles that praise the candidate and dismiss those that are critical. It's the same with investing. We often see people selectively focusing on positive news about a company they've invested in, while ignoring warning signs or negative reports. The first thing to understand is that confirmation bias can lead to overconfidence and poor investment decisions. Beyond that, consider actively seeking out opposing viewpoints and challenging your own assumptions. What really makes the difference is to be open to new information and to be willing to change your mind when the evidence warrants it. It is essential to create a process to avoid being blindsided to market conditions. Actively seeking opposing viewpoints helps overcome confirmation bias and improve investment decision-making. Open mind, clearer find. Let's take this a step further. Loss aversion is another powerful psychological bias that significantly impacts investors. It refers to the tendency to feel the pain of a loss more strongly than the pleasure of an equivalent gain. Think about finding $20 on the street versus losing $20 you already had. Most people would feel the pain of losing the money more acutely than the joy of finding it. It is the same with investing. We often see people holding on to losing investments for too long, hoping they will eventually recover, even when the fundamentals have deteriorated. The first thing to understand is that loss aversion can lead to irrational investment decisions, such as refusing to sell losing positions, or taking excessive risks to try to recoup losses. Beyond that, consider setting stop-loss orders to automatically limit your potential losses on any given investment. What really makes the difference is to be willing to cut your losses and move on to better opportunities. It is imperative to not become emotionally attached to an investment. Being willing to cut losses is crucial for protecting your capital and maximizing long-term returns. Cut losses short, stay in the fort.
While that covers the essentials, seasoned professionals know there's more. The fear of missing out, or FOMO, is a pervasive emotion that can lead investors to make impulsive and irrational decisions. It's the feeling that everyone else is getting rich while you're being left behind. Think about seeing a long line outside a new restaurant. You might be tempted to join the line, even if you're not particularly hungry, simply because you don't want to miss out on what everyone else is experiencing. It is the same with investing. We often see people chasing after hot stocks or speculative assets, driven by the fear of missing out on potential gains, only to buy at the top and lose money when the bubble bursts. The first thing to understand is that FOMO is often fueled by social media and market hype. Beyond that, consider developing a disciplined investment strategy and sticking to it, regardless of what others are doing. What really makes the difference is to avoid making impulsive decisions based on short-term market trends. It is essential to do your own research and to invest only in companies that you understand. Disciplined investing, steady growth. Avoid the hype, secure the ripe. As we move from the why into the how. The key to managing your emotions in investing is to maintain a long-term perspective. Investing is not a get-rich-quick scheme. It's a long-term journey. Think about planting a tree. You don't expect it to grow into a mighty oak overnight. It takes time, patience, and consistent care. Similarly, building wealth through investing requires a long-term focus and the discipline to stick to your plan through market ups and downs. We often see people getting discouraged by short-term market volatility and making impulsive decisions that derail their long-term financial goals. The first thing to understand is that having clear, long-term financial goals can help you stay grounded and disciplined during periods of market turbulence. Beyond that, consider regularly reviewing your portfolio and rebalancing it as needed to maintain your desired asset allocation. What really makes a difference is to remember that investing is a marathon, not a sprint, and that the key to success is to stay focused on your long-term goals and to avoid letting emotions cloud your judgment. Let's take a moment to visualize your long-term financial goals, feeling the security and freedom that comes with achieving them. Focusing on long-term goals provides the discipline and perspective needed to navigate market volatility. Long view clear, conquer fear. Chapter 10. Building your portfolio, step-by-step guide. Think about building a house. You wouldn't just start hammering nails without a blueprint, would you? You'd first need to determine what kind of house you want, how many rooms you need, and when you need it to be completed. Similarly, before you start investing, it's essential to clarify your investment goals and timeline. What are you saving for? When will you need the money? These are crucial questions that will guide your investment strategy and help you build a portfolio that aligns with your specific needs. The first thing to understand is that clearly defined investment goals are the foundation of a successful portfolio. Beyond that, consider that common investment goals include retirement, education expenses, a down payment on a house, or simply building long-term wealth. What really makes the difference is to align your investment strategy with your specific goals and timeline. For instance, if you're saving for retirement decades away, you can afford to take on more risk than if you're saving for a down payment in the next few years. Clearly defining your investment goals provides a roadmap for building a portfolio aligned with your financial needs. Goals in sight. Invest with might. With that foundation firmly in place, selecting the right type of investment account is just as important as choosing the right investments. It's like choosing the right container for your plants. Some plants thrive in pots, while others need to be planted directly in the ground. Similarly, different investment accounts offer different tax advantages and are suitable for different investment goals. We often see people overlooking the importance of choosing the right account, which can result in paying unnecessary taxes and hindering their long-term financial success. The first thing to understand is that different types of investment accounts offer different tax advantages. Beyond that, consider familiarizing yourself with various account types, such as taxable brokerage accounts,
Roth IRAs, traditional IRAs, and 401ks. What really makes the difference is to select the appropriate account based on your tax situation and investment goals. If you anticipate being in a higher tax bracket in retirement, a Roth IRA may be more suitable. Conversely, if you need a current tax deduction, a traditional IRA or 401k may be a better choice. Choosing the right investment account can significantly impact your long-term returns by minimizing taxes. Account aligned, future defined. Let's take this a step further. Determining your asset allocation is one of the most crucial decisions you'll make when building your portfolio. It's like creating a balanced meal. You wouldn't just eat protein or just eat carbohydrates. You'd want a mix of different nutrients to ensure you're getting everything your body needs. Similarly, a well-diversified portfolio includes a mix of different asset classes, such as stocks, bonds, and real estate, to manage risk and maximize returns. We often see people putting all their eggs in one basket, only to suffer significant losses when that particular investment declines. The first thing to understand is that your optimal asset allocation depends on your risk tolerance and investment timeline. Beyond that, consider that stocks generally offer higher potential returns but also carry greater risk, while bonds are typically less volatile but offer lower returns. What really makes the difference is to diversify across different asset classes, to manage risk, and to adjust your asset allocation as your circumstances change. For example, as you get closer to retirement, you may want to shift towards a more conservative allocation with a higher percentage of bonds. Diversifying your portfolio across different asset classes helps manage risk and improve long-term returns. Diversify wide, safely ride. While that covers the essentials, seasoned professionals know there's more. When it comes to investing in the stock market, you have a choice to make. Invest in individual stocks or exchange-traded funds, also known as ETFs. Think about buying ingredients for a cake. You could buy each ingredient separately: flour, sugar, eggs, and butter. Or you could buy a pre-mixed cake mix that contains all the ingredients you need in the right proportions. Similarly, you could invest in individual stocks, carefully selecting each company based on your research. Or you could invest in an ETF that holds a basket of stocks, providing instant diversification. We often see people struggling to pick individual stocks, only to underperform the market. The first thing to understand is that individual stocks offer the potential for higher returns, but they also carry greater risk. Beyond that, consider that ETFs offer instant diversification and typically have lower management fees than mutual funds. What really makes the difference is to carefully consider your investment goals, risk tolerance, and time horizon when deciding whether to invest in individual stocks or ETFs. Another critical element to consider is the tax implications of either strategy. Choosing between individual stocks and ETFs depends on your investment goals, risk tolerance, and desire for diversification. ETFs or stocks, know your docs. As we move from the why into the how, one of the biggest mistakes people make is waiting too long to start investing. It's like planting a seed. The sooner you plant it, the sooner it will start to grow. Even small amounts invested consistently over time can grow into a significant sum, thanks to the power of compounding. We often see people thinking they need a large sum of money to start investing, but that's simply not true. The first thing to understand is that it's never too early or too late to start investing. Beyond that, consider starting with small amounts that you can comfortably afford and gradually increase your contributions over time. What really makes the difference is to make investing a habit and to automate your contributions whenever possible. The final piece of this puzzle involves reinvesting any dividends or capital gains you receive, which will further accelerate the compounding process. Small, consistent investments can lead to significant wealth accumulation over the long term. Start small, grow tall. Chapter 11. Common investment mistakes and how to avoid them. Think of the California gold rush. Thousands of people rushed to California, hoping to strike it rich overnight. While a few struck gold, most ended up losing everything. Similarly, in the stock market, there's always a temptation to chase after hot stocks, or so-called meme stocks, that are generating a lot of buzz. However, investing in these types of companies without understanding their fundamentals can be a recipe for disaster. The key to long-term investment success is to focus on fundamentally strong companies with a proven track record and a solid business model. The first thing to understand is that chasing hot stocks or meme stocks is often driven by greed and the fear of missing out, rather than sound investment principles. Beyond that,
consider that many of these companies are overvalued and lack sustainable business models. What really makes the difference is to focus on investing in companies with strong financials, a competitive advantage, and a proven track record of generating profits. Another critical element is to always do your own research and to avoid making impulsive decisions based on market hype. Investing based on fundamentals, not hype, protects your capital and improves your chances of long-term success. Fundamentals first, profits will burst. With that foundation firmly in place. One of the most common and costly investment mistakes is failing to diversify your portfolio. It's like putting all your eggs in one basket. If you drop the basket, you lose everything. Similarly, if you concentrate your investments in a single stock or industry, you're exposing yourself to unnecessary risk. We often see people investing heavily in their employer's stock, which can be especially dangerous if the company runs into financial trouble. The first thing to understand is that diversification is a key principle of sound investing. Beyond that, consider that diversification reduces portfolio volatility and minimizes potential losses. What really makes the difference is to diversify across different asset classes, industries, and geographic regions. Consider a portfolio that holds a variety of stocks, bonds, real estate, and commodities. Now compare that to a portfolio that only holds shares of a single tech company. Which one do you think is more likely to withstand a market downturn?
Diversification is key to reducing risk and protecting your portfolio from unexpected losses. Spread the risk, gain the bisque.
Let's take this a step further. Investing can be an emotional roller coaster, but it's crucial to make rational decisions, not emotional ones. Think about driving a car. If you panic every time you encounter a bump in the road, you're likely to crash. Similarly, if you let fear and greed dictate your investment decisions, you're likely to make costly mistakes. We often see people selling low during market downturns, driven by fear, and buying high during market rallies, driven by greed. The first thing to understand is that emotional investing is a recipe for disaster. Beyond that, consider that fear and greed can lead to impulsive decisions that derail your long-term financial goals. What really makes the difference is to develop a disciplined investment strategy and to stick to it, regardless of market conditions. Another critical element is to avoid checking your portfolio too frequently, as this can lead to emotional decision-making. Controlling your emotions is essential for making sound investment decisions and achieving long-term financial success.
Rational thought. Wealth is caught.
While that covers the essentials, seasoned professionals know there's more. Failing to rebalance your portfolio is a common mistake that can lead to unintended risk and missed opportunities. It's like neglecting to rotate the tires on your car. Eventually, some tires will wear out faster than others, leading to an unbalanced and potentially dangerous ride. Similarly, over time, some asset classes in your portfolio will outperform others, causing your asset allocation to drift away from your desired target. We often see people setting an initial asset allocation, but then failing to rebalance their portfolio periodically, which can significantly increase their risk exposure. The first thing to understand is that rebalancing involves selling some of your winning assets and buying more of your losing assets to restore your portfolio to its original asset allocation. Beyond that, consider that rebalancing helps to control risk and capture gains by ensuring that your portfolio remains aligned with your risk tolerance and investment goals. What really makes the difference is to rebalance your portfolio at least annually, or more frequently if market conditions warrant it. Rebalancing your portfolio periodically helps to maintain your desired asset allocation, manage risk, and capture gains. Rebalance to enhance financial chance. As we move from the why into the how, one of the biggest mistakes that I see investors make is jumping into the markets without a plan. It's like embarking on a road trip without a map or a destination. You might end up somewhere interesting, but you're more likely to get lost and waste time and resources. Similarly, investing without a well-defined plan can lead to haphazard decisions and poor outcomes. We often see people buying and selling investments based on hunches or gut feelings, rather than a clear and rational strategy. The first thing to understand is that a solid investment plan is the foundation for long-term success. Beyond that, consider that your plan should include well-defined goals, a clear understanding of your risk tolerance, and a diversified asset allocation strategy. What really makes the difference is to write down your plan and to review it periodically to ensure that it remains aligned with your changing circumstances. The final piece of this puzzle involves sticking to your plan, even when the markets get volatile. A well-defined investment plan provides a roadmap for achieving your financial goals and avoiding costly mistakes.
Plan to invest, destined to manifest.
Chapter 12. Tools and Resources for the Informed Investor.
Imagine trying to navigate a foreign city without a map or a guidebook.
You'd likely feel lost, confused, and overwhelmed. Similarly, investing in the stock market without access to reliable information and resources can be a daunting and potentially costly experience. Staying informed about market trends, economic developments, and company performance is crucial for making sound investment decisions. However, it's equally important to avoid information overload and to focus on reputable sources that provide accurate and unbiased information.
The first thing to understand is that access to reliable information is essential for becoming an informed investor.
Beyond that, consider subscribing to reputable financial news websites and publications, such as the Wall Street Journal, Bloomberg, and Reuters. What really makes the difference is to stay informed about market trends, but to avoid getting caught up in the daily noise and short-term fluctuations. Another critical element is to be selective about the sources you trust, and to be wary of biased or sensationalized reporting. Staying informed through reputable sources is vital for making informed investment decisions while avoiding information overload. Informed view, choices accrue.
With that foundation firmly in place,
choosing the right brokerage platform is like choosing the right set of tools for a job. You wouldn't try to build a house with just a hammer and a screwdriver. You'd need a variety of tools to get the job done right. Similarly, different brokerage platforms offer different features, fees, and levels of customer service. We often see people signing up with the first brokerage they find, without carefully considering their investing needs and budget. The first thing to understand is that different brokerage platforms cater to different types of investors. Beyond that, consider comparing different platforms based on factors such as trading fees, account minimums, investment options, research tools, and customer service. What really makes the difference is to choose a platform that meets your specific investing needs and budget. If you're a beginner investor, you may want to choose a platform with low fees and user-friendly tools. If you're a more active trader, you may need a platform with advanced charting and analysis capabilities. Selecting the right brokerage platform can significantly impact your investing experience and overall returns.
Platform-wise, investments rise.
Let's take this a step further. Before investing in any stock or ETF, it's crucial to conduct thorough due diligence. It's like inspecting a house before you buy it. You wouldn't just hand over the money without checking for structural problems or pest infestations, would you? Similarly, you shouldn't invest in a company or fund without carefully analyzing its financials, business model, and competitive landscape. We often see people investing based on recommendations from friends or family, without doing their own research. The first thing to understand is that there are numerous investment research tools available to help you analyze stocks and ETFs. Beyond that, consider utilizing resources such as company financial statements, industry reports, and analyst ratings. What really makes the difference is to use these tools to assess the company's profitability, growth potential, and financial health before investing. Another critical element is to understand the risks associated with the investment, and to determine whether it aligns with your risk tolerance and investment goals. Thorough due diligence, using investment research tools, is essential for making informed investment decisions. Research deep, profits to keep. While that covers the essentials, seasoned professionals know there's more. While there's a wealth of information available to help you manage your investments, sometimes it's beneficial to seek professional guidance. Think about learning a new skill.
You could try to teach yourself from books and online tutorials, but you might progress faster and avoid common mistakes by working with a coach or mentor. Similarly, a financial advisor can provide personalized advice, help you develop a comprehensive financial plan, and manage your investments on your behalf. We often see people struggling to manage their investments on their own, particularly when they have complex financial situations or lack the time or expertise. The first thing to understand is that a financial advisor can provide valuable assistance, particularly if you're new to investing or have complex financial needs. Beyond that, consider that a good financial advisor will take the time to understand your goals, risk tolerance, and time horizon, and then develop a personalized investment strategy that aligns with your needs. What really makes a difference is to choose a financial advisor who is qualified, experienced, and trustworthy. Professional financial guidance can provide personalized advice and help you navigate the complexities of investing. Guidance sought, wealth is brought. As we move from the why into the how, the world of investing is constantly evolving, and it's essential to remain a lifelong learner. Think about learning to play a musical instrument. You wouldn't just take a few lessons and then stop practicing, would you? You'd need to continue learning and honing your skills to improve over time. Similarly, in investing, it's crucial to stay up to date on market trends, new investment strategies, and changes in regulations. We often see people relying on outdated information or failing to adapt to changing market conditions. The first thing to understand is that there are numerous resources available to help you expand your investment knowledge. Beyond that, consider taking online courses, attending seminars, and reading books on investing. What really makes the difference is to make learning a continuous process and to actively seek out new information and insights. The final piece of this puzzle involves applying what you learn to your own investment strategy and to adapt as needed. Let's take a moment to visualize ourselves confidently navigating the investment world, empowered by knowledge and understanding. Continuous learning empowers you to make informed decisions and achieve your financial goals. Knowledge earns, turn after turn. Chapter 13. Maintaining a long-term perspective. Staying the course. Think about a long-distance runner preparing for a marathon. They know there will be tough stretches, hills to climb, and moments of doubt. But they also know that success depends on staying focused on their goal and persevering through the challenges.
Similarly, market volatility is an inevitable part of investing. There will be ups and downs, periods of rapid growth, and periods of decline. The key to long-term success is to develop strategies for staying calm during market downturns and to avoid making impulsive decisions based on fear. The first thing to understand is that market volatility is a normal and natural part of investing. Beyond that, consider that market downturns can actually create opportunities to buy undervalued assets. What really makes the difference is to develop a long-term perspective and to focus on your financial goals, rather than getting caught up in short-term market fluctuations. Another critical element is to avoid checking your portfolio too frequently, as this can lead to emotional decision-making. Market fluctuations are inevitable. Maintaining a long-term perspective is essential for navigating them successfully.
Long-term sight, financial might. With that foundation firmly in place, patience and discipline are essential ingredients for long-term investment success. It's like planting a tree. You wouldn't expect it to grow overnight, would you? It takes time, consistent care, and patience for the tree to mature and bear fruit. Similarly, building wealth through investing requires a long-term perspective and the discipline to stick to your plan, even when the markets get turbulent. We often see people getting discouraged by short-term market fluctuations and abandoning their investment strategy, which can significantly hinder their long-term returns. The first thing to understand is that investing is a marathon, not a sprint.
Beyond that, consider that time is your greatest ally when it comes to compounding returns. What really makes the difference is to avoid making impulsive decisions based on short-term market fluctuations and to stay focused on your long-term financial goals. Another critical element is to regularly review your portfolio and to make adjustments as needed, but only in accordance with your long-term investment plan. Patience and discipline are essential for achieving long-term investment success and building lasting wealth. Patient now, fortune somehow. Let's take this a step further. Even with a well-defined investment plan, it's essential to schedule regular portfolio reviews. Think of it as getting a regular checkup with your doctor. You wouldn't just assume that you're healthy without getting regular checkups, would you? Similarly, you shouldn't assume that your portfolio is on track without reviewing it periodically to assess your progress and make necessary adjustments. We often see people setting up their portfolio and then forgetting about it for years, which can lead to significant deviations from their original investment plan. The first thing to understand is that regular portfolio reviews are essential for staying on track with your financial goals. Beyond that, consider scheduling a review at least annually, or more frequently if your circumstances change. What really makes the difference is to use these reviews to assess your portfolio's performance, to rebalance your asset allocation if necessary, and to make sure that your investments still align with your risk tolerance and time horizon. Another critical element is to reassess your financial goals and to make adjustments to your investment plan as needed. Regular portfolio reviews help you stay on track with your financial goals and ensure that your investments continue to align with your needs. Review often, target soften.
While that covers the essentials, seasoned professionals know there's more. Life is a journey, and your investment strategy should adapt to the changing landscape. Think about planning a road trip. You might start with a specific route in mind, but you might need to make detours or change your plans along the way due to unforeseen circumstances. Similarly, your life circumstances will inevitably change over time, whether it's getting married, having children, changing jobs, or approaching retirement. We often see people sticking to the same investment strategy for decades, even though their needs and goals have evolved significantly. The first thing to understand is that your investment plan should be flexible and adaptable to your changing life circumstances. Beyond that, consider that significant life events may require you to adjust your asset allocation, risk tolerance, or investment goals. What really makes a difference is to reassess your financial situation and to make necessary adjustments to your investment plan whenever major life events occur. Your investment strategy should evolve alongside your life circumstances to ensure that you stay on track to achieve your financial goals. Adapt and grow. Watch wealth flow. As we move from the why into the how. Once you've created a sound investment plan, the most important thing you can do is to stick to it. Think about building a house. You wouldn't randomly change the blueprints halfway through construction, would you? That would lead to chaos and potentially compromise the structural integrity of the building. Similarly, constantly changing your investment strategy based on short-term market fluctuations can derail your long-term financial goals. We often see people abandoning their investment plans during market downturns, only to miss out on the subsequent recovery. The first thing to understand is that consistency is key to long-term investment success. Beyond that, consider that a well-diversified portfolio is designed to weather market volatility. What really makes the difference is to resist the temptation to make impulsive decisions based on fear or greed, and to stay focused on your long-term financial objectives. Remember, it's about time times the market, not timing the market. Following your investment plan consistently and making adjustments only when significant changes occur in your life is critical for achieving your long-term financial goals. Plan in sight, future bright. Chapter 14. Conclusion. Your journey to confident investing. Imagine standing at the foot of a mountain, looking up at the summit. The climb may seem daunting, but with the right preparation, tools, and mindset, you can reach the top. This audiobook has been your guide, providing you with the knowledge and strategies you need to navigate the world of investing with confidence. From understanding the basics of the stock market to mastering the art of long-term investing, we've covered a wide range of topics designed to empower you on your financial journey. Throughout this book, we have emphasized the importance of a disciplined approach, starting with building a solid foundation of knowledge, then the importance of controlling your emotions, and avoiding common pitfalls that can derail even the most well-intentioned investors. And all of this leads to building wealth over time. Let's take a moment to appreciate the progress we've made and visualize ourselves confidently managing our investments and achieving our financial goals. By embracing the principles and strategies outlined in this audiobook, you are well equipped to embark on your journey to confident and successful investing. Mindset strong, wealth along. With that foundation firmly in place, the core message of this audiobook has been empowerment, empowering you to take control of your financial future and to build the wealth you deserve. It's like giving someone the keys to a car. The car itself is a valuable asset, but it's the driver who ultimately determines where it goes and how it's used. Similarly, the knowledge and strategies you've gained in this audiobook are valuable tools, but it's your own initiative and commitment that will determine your financial success. We often see people passively relying on others to manage their finances, but true financial freedom comes from taking ownership and actively participating in the process. The first thing to understand is that you have the power to shape your financial destiny. Beyond that, consider that every small step you take towards financial literacy and responsible investing brings you closer to your goals. What really makes the difference is to stay positive, never give up on yourself, and to keep learning and growing throughout your investment journey. Remember, the keys to financial freedom are now in your hands. Believe and achieve, you will receive. Let's take this a step further. The knowledge you've acquired is powerful, but it's only valuable if you put it into action. It's like owning a set of blueprints for your dream house. Those blueprints are useless unless you start building. Don't let this information simply sit on a shelf, gathering dust. Think about how many people attend seminars or read self-help books but never actually implement what they've learned. The world is full of would-be successes, but the real difference is found in the doing. The first thing to understand is that taking action is the single most important step toward achieving your financial goals. Beyond that, consider starting small. Even if it's just opening a brokerage account or setting up an automatic investment plan, what really makes the difference is to overcome inertia and to make a commitment to taking consistent action, no matter how small. Another critical element is to celebrate your progress along the way, and to remember why you started this journey in the first place. Now is the moment to translate knowledge into action, transforming your financial future one step at a time. Start today. Wealth pave the way. While that covers the essentials, seasoned professionals know there's more.
Your journey to confident investing doesn't end here, it's just the beginning. Think about learning a new language. Completing a course is a great start, but fluency requires ongoing practice and immersion. Similarly, the world of investing is constantly evolving, and continuous learning is essential for staying ahead of the curve and adapting to changing market conditions. We often see people becoming complacent after achieving some initial success, which can lead to missed opportunities and costly mistakes. The first thing to understand is that staying informed is a lifelong commitment. Beyond that, consider subscribing to reputable financial news sources, joining investment clubs, and attending industry events. What really makes the difference is to actively seek out new knowledge and to never stop questioning your assumptions. Remember, the more you learn, the more confident and successful you'll become as an investor. Remember to seek out opportunities for continuous learning to ensure that you're equipped for long-term success. Always explore wealth in store. As we move from the why into the how, investing is a personal journey, and there isn't a one-size-fits-all answer. So I encourage you to continue learning and to implement what resonates with you the most. Many feel overwhelmed when presented with a large amount of material. I simply urge you to not get caught in paralysis by analysis. Instead, start small and be consistent. Before we close, let's take a moment to reflect on the journey we've taken together. Visualize the financial goals you're striving for, and feel the confidence that comes from taking control of your financial future. It has been an honor to be your guide on this journey, and I sincerely appreciate you entrusting me with your time and attention. I wish you the very best on your journey to building lasting wealth. Trust the process, manifest success.